Hello everyone, and welcome back to Money, Finance, Wealth. Today we're tackling a critical topic for your long-term financial security Roth IRAs versus traditional IRAs. Before we dive in, if you're new here, please hit that like button, subscribe to the channel and ring the notification bell so you never miss out on our in-depth guides to mastering your finances. We're all about providing you with the knowledge you need to build a secure financial future. Now, let's get down to business. Choosing the right retirement savings vehicle can be daunting. IRAs or individual retirement accounts are a popular option, but understanding the nuances between Roth and traditional IRAs is essential for making informed decisions. They both offer tax advantages, but those advantages operate in vastly different ways. Choosing the right one can potentially save you tens or even hundreds of thousands of dollars over your lifetime. We're going to explore the core differences, contribution rules, tax implications, withdrawal guidelines, and ultimately help you determine which type of IRA aligns best with your individual circumstances and financial goals. Get ready for a deep dive. Let's start with the basics. What is an IRA? An IRA, or individual retirement account, is a tax-advantaged savings account that allows individuals to save for retirement. Unlike employer-sponsored plans like 401(k)s, IRAs are generally opened and managed by individuals, giving you greater control over your investments. Think of it as a personal savings account specifically designed for retirement, with some powerful tax benefits attached. The primary purpose of an IRA is to encourage individuals to save for retirement by offering tax incentives. This means that either your contributions are tax-deductible, your earnings grow tax-free, or your withdrawals in retirement are tax-free, or some combination thereof. These tax advantages are a huge benefit, as they can significantly increase your retirement savings over time. Without the tax shelter of an IRA, investment earnings would be subject to taxation annually, which can eat into your overall growth. Now, there are several different types of IRAs, but today we're focusing on the two most common, the Roth IRA and the traditional IRA. While they share the common goal of retirement savings, they differ significantly in how they are taxed. Let's begin with the traditional IRA. A traditional IRA is a retirement savings account that offers the potential for tax-deductible contributions. This means that you may be able to deduct your contributions from your taxable income in the year you make them, potentially lowering your tax bill. The earnings within a traditional IRA grow tax-deferred, meaning you don't pay taxes on the investment gains until you withdraw the money in retirement. A key advantage of the traditional IRA is the potential for immediate tax savings. By deducting your contributions, you can reduce your current taxable income, which can be particularly appealing if you're in a higher tax bracket now and expect to be in a lower one in retirement. However, it's important to remember that you'll eventually pay taxes on those contributions, along with the investment earnings, when you withdraw the money in retirement. So here's how the tax benefits of a traditional IRA work. You contribute money to the IRA, and if you qualify, you deduct that contribution from your income, which reduces the amount of tax you pay that year. Then, while the money is sitting in the IRA, it grows tax deferred. This means you don't pay taxes on the dividends, interest, or capital gains that your investments earn until you withdraw the money in retirement. Finally, when you take distributions in retirement, those withdrawals are taxed as ordinary income. The deductibility of your traditional IRA contributions is subject to certain limitations, particularly if you are also covered by a retirement plan at work. This is an important point to understand because it can affect whether or not you can deduct the full amount of your contributions. If you are covered by a retirement plan at work, such as a 401(k), your ability to deduct your traditional IRA contributions depends on your income. The IRS sets income limits each year that determine the extent to which you can deduct your contributions. If your income is above a certain threshold, you may only be able to deduct a portion of your contributions, or you may not be able to deduct them at all. If you are not covered by a retirement plan at work, you can generally deduct the full amount of your traditional IRA contributions, regardless of your income. However, if your spouse is covered by a retirement plan at work, your ability to deduct contributions may be limited based on your combined income. Now, let's talk about contribution limits. The IRS sets annual limits on how much you can contribute to a traditional IRA. These limits are subject to change each year, so it's important to stay informed. For example, in Insert Current Year, the contribution limit for traditional IRAs is Insert Current Year's limit for individuals under age 50, and Insert Current Year's limit plus catch-up contribution for those age 50 or older. These limits apply to the combined total of all your IRA contributions, including both traditional and Roth IRAs. You cannot contribute more than the limit, regardless of how many IRAs you have. It's also important to note that you cannot contribute more than your taxable compensation for the year. In other words, you can only contribute up to the amount you earned from working. This rule prevents people from funding their IRAs with money from sources other than earned income, such as gifts or inheritances. When it comes to withdrawals, traditional IRAs have specific rules. Generally, you can start taking withdrawals from your traditional IRA at age 59 and a half. If you withdraw money before age 59 and a half, you may be subject to a 10% early withdrawal penalty, in addition to paying income taxes on the withdrawn amount. This penalty is designed to discourage people from using their retirement savings for non-retirement purposes. However, there are some exceptions to the early withdrawal penalty. These exceptions include withdrawals for qualified higher education expenses, the purchase of a first home, up to a certain limit, unreimbursed medical expenses exceeding a certain percentage of your adjusted gross income, and certain other specific circumstances. It's important to research these exceptions carefully to see if you qualify. Required minimum distributions, or RMDs, are another important consideration with traditional IRAs. RMDs are the minimum amounts you must withdraw from your traditional IRA each year, starting at age 73 as of 2023. This age may change in the future. The amount of your RMD is based on your age and the balance of your IRA at the end of the previous year. The IRS provides a worksheet to help you calculate your RMD each year. Failing to take your RMDs can result in a hefty penalty, so it's crucial to understand and comply with these rules. Now, let's move on to the Roth IRA. A Roth IRA is another type of retirement savings account, but it differs significantly from the traditional IRA in its tax treatment. With a Roth IRA, your contributions are made with after-tax dollars. This means you don't get a tax deduction for your contributions in the year you make them. However, the big advantage is that your earnings grow tax-free, and your withdrawals in retirement are also tax-free, as long as certain conditions are met. The Roth IRA is particularly appealing to individuals who believe they will be in a higher tax bracket in retirement than they are now. Because you pay taxes on your contributions up front, you avoid paying taxes on the potentially larger sum you withdraw in retirement. This can result in significant tax savings over the long term. While Roth IRAs don't offer an upfront tax deduction, the long-term tax benefits can be substantial. Imagine contributing consistently to a Roth IRA for many years, and your investments grow significantly over time. When you finally retire and start taking withdrawals, you won't owe a single penny in taxes on those withdrawals. This can provide a tremendous sense of security and financial freedom in retirement. Like traditional IRAs, Roth IRAs also have income limitations. In order to contribute to a Roth IRA, your income must be below a certain level. The IRS sets these income limits each year, and they vary depending on your filing status. If your income exceeds these limits, you may not be able to contribute to a Roth IRA directly. However, there are ways to get around these limitations, such as through a backdoor Roth IRA, which we'll discuss later. The contribution limits for Roth IRAs are the same as for traditional IRAs. As mentioned earlier, in Insert Current Year, the contribution limit is Insert Current Year's limit for individuals under age 50, and Insert Current Year's limit plus catch-up contribution for those age 50 or older. These limits apply to the combined total of all your IRA contributions, including both traditional and Roth IRAs. One of the most attractive features of Roth IRAs is the flexibility they offer when it comes to withdrawals. Unlike traditional IRAs, you can withdraw your contributions from a Roth IRA at any time for any reason without penalty or taxes. This can be a valuable safety net in case of unexpected expenses or financial emergencies. However, the rules are different for withdrawing earnings from a Roth IRA. To withdraw earnings tax-free and penalty-free, you must be at least age 59 and a half, and the Roth IRA must have been open for at least 5 years. This 5-year rule is important to keep in mind as it applies to each Roth IRA you own. If you withdraw earnings before meeting both of these requirements, you may be subject to taxes and penalties. There are also some exceptions to the early withdrawal penalty for Roth IRA earnings, similar to those for traditional IRAs. These exceptions include withdrawals for qualified higher education expenses, the purchase of a first home up to a certain limit, unreimbursed medical expenses, and certain other specific circumstances. Unlike traditional IRAs, Roth IRAs are not subject to required minimum distributions, RMDs, during the original owner's lifetime. This means you can leave your money in the Roth IRA to grow tax-free for as long as you live, and you don't have to worry about taking withdrawals you don't need. This can be a significant advantage for individuals who want to maximize their tax-free growth potential and leave a larger inheritance for their heirs. Now that we've covered the basics of both traditional and Roth IRAs, let's do a direct comparison to highlight the key differences. Tax treatment. Traditional IRA contributions may be tax deductible, earnings grow tax deferred, and withdrawals are taxed as ordinary income. Roth IRA contributions are made with after-tax dollars, earnings grow tax-free, and qualified withdrawals are tax-free. Contribution limits. The contribution limits are the same for both traditional and Roth IRAs. Income limits. Traditional IRAs have income limits that affect deductibility of contributions if you are covered by a retirement plan at work. Roth IRAs have income limits that affect eligibility to contribute. Withdrawals. Traditional IRA withdrawals are taxed as ordinary income, and early withdrawals may be subject to a 10% penalty. Roth IRA contributions can be withdrawn tax-free and penalty-free at any time, and qualified earnings withdrawals are also tax-free and penalty-free. Required minimum distributions, RMDs. Traditional IRAs are subject to RMDs starting at age 73, subject to change. Roth IRAs are not subject to RMDs during the original owner's lifetime. The choice between a Roth IRA and a traditional IRA depends on your individual circumstances, financial goals, and expectations about future tax rates. If you believe you will be in a higher tax bracket in retirement, a Roth IRA may be the better choice. If you need the immediate tax deduction now and expect to be in a lower tax bracket in retirement, a traditional IRA may be more suitable. Let's delve deeper into the factors you should consider when choosing between a Roth IRA and a traditional IRA. Current versus future tax bracket. This is perhaps the most important factor to consider. If you expect to be in a higher tax bracket in retirement than you are now, a Roth IRA is generally the better choice. This is because you'll pay taxes on your contributions now when your tax rate is lower, and then enjoy tax-free withdrawals in retirement when your tax rate is higher. Conversely, if you expect to be in a lower tax bracket in retirement, a traditional IRA may be more advantageous. You'll get a tax deduction now when your tax rate is higher, and then pay taxes on your withdrawals in retirement when your tax rate is lower. Age can also play a role in your decision. Younger investors often benefit more from Roth IRAs because they have more time for their investments to grow tax-free. Older investors may prefer traditional IRAs if they need the immediate tax deduction to reduce their current tax liability. Income. Your current income level is also a factor to consider, as it can affect your eligibility to contribute to a Roth IRA. If your income is too high to contribute to a Roth IRA directly, you may need to consider a backdoor Roth IRA. Investment timeline. The longer your investment timeline, the more time your investments have to grow tax-free in a Roth IRA. This can make Roth IRAs particularly attractive for young investors who have decades until retirement. Risk tolerance. While risk tolerance doesn't directly determine whether you should choose a Roth or traditional IRA, it can influence your investment strategy within the IRA. If you are a more conservative investor, you may prefer to invest in lower risk assets such as bonds or dividend-paying stocks. If you are a more aggressive investor, you may be willing to take on more risk in exchange for the potential for higher returns. Financial goals. Your overall financial goals should also be considered. Are you saving for retirement? Do you have other financial goals, such as buying a home or paying for your children's education? The type of IRA you choose can impact your ability to achieve these goals. Employer-sponsored retirement plans. If you participate in an employer-sponsored retirement plan, such as a 401k, this can also affect your decision. If you are already contributing enough to your 401k to receive the full employer match, you may want to consider opening a Roth IRA to further diversify your retirement savings. For those with high incomes who are ineligible to contribute to a Roth IRA directly, there's a strategy known as the backdoor Roth IRA. This involves contributing to a traditional IRA and then converting it to a Roth IRA. Here's how it works. Contribute to a non-deductible traditional IRA. You contribute to a traditional IRA, but you don't take a tax deduction for the contribution. This is because your income is too high to qualify for a deduction. Convert to a Roth IRA. You then convert the traditional IRA to a Roth IRA. This conversion is generally a taxable event, but if you don't have any pre-tax money in the traditional IRA, the tax impact will be minimal. Enjoy tax-free growth. Once the money is in the Roth IRA, it grows tax-free. And withdrawals in retirement are also tax-free. It's important to note that the backdoor Roth IRA strategy can be complex, and it's essential to understand the potential tax implications before proceeding. It's also important to avoid the pro rata rule, which can complicate the conversion if you have other pre-tax money in traditional IRAs. Consider consulting with a tax advisor to determine if the backdoor Roth IRA is right for you. While we've focused on traditional and Roth IRAs, it's worth briefly mentioning SEP IRAs and simple IRAs, which are retirement plans designed for self-employed individuals and small business owners. SEP IRA, or Simplified Employee Pension, allows self-employed individuals and small business owners to contribute to their own retirement accounts. Contributions are tax-deductible and earnings grow tax-deferred. The contribution limits for SEP IRAs are generally higher than for traditional or Roth IRAs. Simple IRA, or Savings Incentive Match Plan for employees, is another retirement plan option for small business owners. It allows employees to contribute to their own retirement accounts, and employers are required to make matching contributions. Contributions are tax-deductible, and earnings grow tax-deferred. These plans can be a great way for self-employed individuals and small business owners to save for retirement while also enjoying tax benefits. However, it's important to understand the rules and regulations governing these plans before setting one up. Let's talk about some common mistakes people make when it comes to IRAs. Contributing too much. It's important to stay within the annual contribution limits for IRAs. Contributing too much can result in penalties, missing the contribution deadline. The deadline to contribute to an IRA for a given year is typically the tax filing deadline in April of the following year. Missing this deadline means you won't be able to contribute for that year. Not understanding the withdrawal rules. It's crucial to understand the withdrawal rules for both traditional and Roth IRAs, including the early withdrawal penalties and the 5-year rule for Roth IRA earnings. Failing to rebalance. As your investments grow, it's important to rebalance your portfolio periodically to ensure that it aligns with your risk tolerance and financial goals, not reviewing your beneficiaries. It's important to review your beneficiaries regularly to ensure that your IRA assets will be distributed according to your wishes. Ignoring fees. Be aware of any fees associated with your IRA, such as account maintenance fees or investment management fees. These fees can eat into your returns over time. Not seeking professional advice. If you're unsure about which type of IRA is right for you or how to invest your IRA assets, consider seeking professional advice from a financial advisor or tax professional. Investing for retirement can feel overwhelming, but with the right knowledge and guidance, you can make informed decisions that set you on the path to financial security. Speaking of guidance, we'd like to thank Fenul Wealth Management for sponsoring this video. If you're looking for personalized financial advice and wealth management solutions, their team can help you navigate the complexities of retirement planning and build a strategy tailored to your specific needs. You can reach them at 888-336-8586, email info@fenul.com, or visit their website at fenulwealthmanagement.com. In summary, both Roth and traditional IRAs offer valuable tax advantages for retirement savings. The best choice for you depends on your individual circumstances, financial goals, and expectations about future tax rates. Thanks for watching Money, Finance, Wealth. We hope this video has helped you better understand the key differences between Roth and traditional IRAs. Remember to consult with a financial advisor or tax professional to determine the best course of action for your specific situation. And before you go, please give this video a like, share it with your friends, and subscribe to our channel for more informative content on all things money, finance, and wealth. Your support helps us continue to create valuable resources for your financial journey. Thanks again for watching, and we'll see you in the next video.